Welcome to the Real Advisor Podcast. TRAP. Trap. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the Trap team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of Trap.
Yes, indeed, dear Trappists. Welcome back to episode 50 of the Real Advisor Podcast, TRAP Trap. My name is Lick Ninken. Joining me, as ever, in the digital studio of doom are the 3 other horsemen of the apocalypse. Alan, the storyteller Smith, back from Turkey. Carl Della Voce Widger, back from Portugal. And, first time ever, Andrew Ultraheart is on the continent in a hot and sweaty Athens. Gentlemen, welcome. How are we doing?
All good.
All good. A little bit hot, but all good.
Good. Okay, let's hope we don't have any tech snafus today. There's no internet dropouts on the continent. I personally am glad that we've hit 50, not because it means anything, it's just an arbitrary number that we don't celebrate, do we? But it means I haven't got to draw any more useless 4s on the board, at least not to episode 54.
I'm the only one of the track pack that's under 50 age, yeah.
Oh, an early shout for Andrew?
I thought it was IQ. Okay. Age. Yep.
No, IQ's still way below 50.
Yeah, correct.
Okay, that cancels out. I'll give you that one. All right. As you're already talking nonsense, Mr. Hart, do you want to crack on and give us 2 more of your high energy review reads, please?
Sure. The first one is from Skinner UK, entitled "Alan Didn't Bottle It, 5 stars. Congratulations, 12 months late." But the honesty now about SJP, it was never ever about how high the charges were, but that their fees are commissioned by another name on the pension and bond wrapper. The front-end loading of advisory remuneration has driven the lack of ongoing servicing, hence the debacle we have seen. Maybe some had greater insights. The fact remains, incentives drive motivation, which drives behaviour. Keep up the good work. I enjoy every episode and listen every time. Next up, private investor, Ashton 1975, private investor, 5 stars. I recently came across the Real Advisor podcast whilst reviewing potential advisors. I'm a private investor, not an advisor. It is a minefield out there, but listening to this podcast brings intelligent debate, clarity, sensible thinking, and good humour, which has really helped my search. Keep up the great work. Thank you.
Have we not read that one out before?
Don't think we have.
That rings a bell.
We spoke about it privately. I don't think we've read it out, unless I've got it wrong. But
Yeah,
sure?
I think you're right, Andy.
That's it.
By the
Back
way,
to
has
you, boss.
Ashton 75 become a client of any of us?
This is what I thought. I thought, yeah.
Well.
Funny.
Cannot possibly disclose.
Oh, God.
Let
me guess.
Podcast has been useful for him to rule us out.
Close personal friend? Yeah.
Yeah.
Good stuff.
And the previous one, what did it say? Alan didn't bottle it. Well, I like it.
Read it
Or
beforehand, my friend.
All right. We're talking about the
Yeah,
SJP
fat
episode.
chance.
Yeah.
Fat job. Okay, thanks
review.
for those.
Is it on your
Ultra?
printed out notes? No, Alan? Alan, you're in your new office. Let's talk about this very briefly.
Sure. What do you want to know?
Yeah, for the 10% that watch us on video, let's do it.
Yeah, more people should watch on YouTube. I'm increasingly. I didn't used to watch podcasts on YouTube. It's quite good to see the dynamics amongst the facial expressions. The All In podcast is great for exactly that, Nicholas. Anyone who's listening missed.
So about the new office, Alan, you've moved to Chancery Lane from the city, a little bit further.
Yeah, Chancery Lane is what they call Midtown, isn't it? It's neither city nor West End. It's a kind of no man's land in between the two. But
Desolate
it's
wasteland.
Still very,
very
central.
for capital asset management.
Very central, very accessible. It's quite a cool area.
Very
actually.
on brand.
Yeah, it's a good area. Just getting used to it. But it's a great office space. We've got all sorts of facilities here. Gym, sauna, jacuzzi.
Great design.
For the current weather, lots of outdoor terraces, outdoor space. You can sit and have a little, team meeting or a conversation on the terrace, have a cup of coffee. So it's all good. Yeah, just moved in a couple of weeks ago. We're quite happy with it so far.
And a massive annual saving, I believe, on the rent. Is that correct?
It's crazy, isn't it? things like this. I just don't understand commercial property and the structure of it. We had a fixed lease, 10-year lease. I took my son here. I came in last Friday, my 16-year-old, and had a look around. He goes, "Oh, this is the best office I've ever seen. Is it much more expensive than your last one?" He goes, "No, it's cheaper, much cheaper than the last one." It's just to do with the dynamics of the dedicated office space. We've got a smaller dedicated space, which is our own, but we've got access, like a co-working space. But it's not. It's a lot more upmarket than your traditional kind of WeWork or some of those other spaces. It's really nice. Clients seem to like it as well. So we're very pleased with the move. Shout out to Shireen, as always, for organising everything and having us in here. So yeah, so far so good.
Brilliant.
Good luck with it,
good
Alan.
stuff.
Can't wait to see it.
Anytime.
Yeah, I never went
what's
to the last
next?
one. I'm not that bothered about the new one. Yeah, so thank you for the reviews that I read out half an hour ago. Thank you very much for those, dear Trappists. And do keep them coming. They do give us a shot in the arm.
He doesn't leave Watford, Alan.
He never leaves Watford. Very
Yeah,
rarely.
God forbid I should never leave Watford. Right, let's move on. Let's give episode 50, let's give it a timestamp with some topical. It's a bit of a quiet period, but we've still got some nuggets to talk about with our topical tidbits, starting off with Della Voce. Oh, good grief. Okay, come on. 30 seconds, the Olympics.
The Olympics, yeah, I love the Olympics. I've been watching all classes of sport over the last couple of days. But
Sport.
yeah, it is. It's magnificent. I absolutely love it. But do you know, there was two things that I kind of thought about when I was watching the coverage. So I've been flicking between the RTE, the Irish coverage, and the BBC British coverage. And I love the way they put so much effort into telling kind of backstories about some of the competitors. And there was a great story about a British swimmer, Adam Peaty.
Yep.
And Gordon Ramsay actually interviewed him on the BBC. He ended up winning a silver medal, but he was going for 3 golds, I think, in 3 different Olympics, which is amazing stuff. But yeah, I the power of storytelling, we shouldn't ever forget that. And we have our own storyteller amongst us here, but it is very powerful stuff, and it makes for brilliant viewing. But also then, when you look at these people, the hard work, the dedication, the discipline over such a long period of time. Like we're watching, swimming that's going to 2 minutes or 3 minutes or 4 minutes or whatever. Like it's decades in the making, and there's good lessons in business for that as well, isn't there? That, there are no shortcuts. People might see the end results, but they don't see all the hard work that goes in over a very, very, very long period of time. Anyway, I just wanted to bring it up because I absolutely love the Olympics.
There's a LinkedIn post there, isn't there? While I was watching XYZ swimmer doing
It
her
reminded
craft
me
in the pool, I realised it had taken years and years and years and years of refinement to her ability and her performance. And that's what we've done to our business. Blah, blah, blah.
Give us a call
That's
about
it.
your pensions.
No, I'm with you, Carl. I enjoy that. One of the best sporting experiences I've ever had in my life. I attended what is called Super Saturday in London 2012. When UK Britain won 3 gold medals.
Mo.
Yeah, and the other one.
Farah, the African runner. Yeah.
Yeah, 3 gold medals in the space of a couple of hours. It was fabulous. It was Saturday afternoon, evening in central London and East London, and sun was shining. Fabulous. I'll always remember those moments. And as you say, it is a culmination of years and years and years of dedication, hard work, commitment. And unfortunately, most actually fail. There's only 1 gold medal winner, and there's lots of others. There's a interesting psychology that says it's better to win a bronze medal. If you can't win the gold, it's better to win a bronze than it is a silver. Because at bronze, you're happy. You say, well, at least I got a medal. At silver, it's
just so close
to getting the gold.
There was some guy last night finished 4th in his event for the 3rd Olympics running. He's finished 4th. Can you imagine the heartbreak?
I just wanted to see a picture of Nick Lincoln during the opening ceremony, the controversial opening ceremony, which was somewhat woke, as some people have said. So, Nick, did you watch it?
When did it take place?
Just to shoehorn Athens in, I was at the original Olympic Stadium yesterday. 1906 was the first Olympics in Athens. It's still there, the stadium.
Yeah.
It's a block of concrete. It's very warm and it's amazing. Simone Biles as well. She's amazing. Her Netflix documentary is brilliant. Watch it. She hasn't yet won all the golds, but that's coming, I think, today or tomorrow. She's an amazing athlete, and all the stars turned up for her. So, yeah, again, more Olympic stories.
Yeah, brilliant.
Very good.
Brilliant.
Okay, thank you for the Olympic podcast. Right, storyteller, cyber security.
I wanted to raise this. I shared it with you guys and some others that we know. Whilst I have been on my travels for the last few weeks, we were called for a kind of urgent Zoom call, Teams call a couple of weeks ago, because there had been kind of overnight in our firm some sort of attempted cyber hacking attack on our systems. And the good news is they were unsuccessful, but we all had to get on a call. The whole team arrived, but we outsource our IT support third-party specialist company. They're monitoring this stuff 24/7. They've got different levels of support. We pretty much pay for the highest level of support. So we all got on the call. They all went through everything as to how this had happened, and they did a screen share, and they showed all of us the log, they call it, and it's just page after page after page of attempted, break-ins, effectively cyber break-ins. And I said, he said, this is happening all the time, and it's happening to most companies all the time. And the main, geographical sources are, as you might expect, maybe Russia, China, parts of Africa, and it's constant. And there was one of our team, unfortunately, didn't update their passwords or something. They kind of got in, but we got a second and third line of defense. This is obviously above my pay grade. I don't really understand it all, but I'm just really keen. I've said for years that cybersecurity is the single biggest issue that financial planning firms should be paying their attention to, not consumer duty, not many of these other things, because we have got, most of us are small businesses, but and for that reason, we haven't got the kind of, the security that Barclays Bank or HSBC or someone has got, I presume. But at the same time, we've got access to very important, very sensitive data that in the hands of cyber criminals and hackers would be very, very valuable. So we are kind of an ideal target for these. Long story short, I was very pleased that we were sort of secure, and we've now, as a consequence of this little threat that we had, we've all kind of gone to another level of two-factor authentication and passwords and blah, 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 a load of other stuff that we're kind of taking it to the ultimate level. We are already certified for something called Cyber Essentials, which, you've got to comply with all sorts of rules and regulations. You have this third-party organization come and test your systems. And we're now going for Cyber Essentials Plus, which is the highest level possible that any firm can do. And that's all we can do. If we ever did get a breach or a hack or something, we would be able to legitimately say that we've done absolutely everything we can. And it's just a kind of a warning shout to anyone listening to this who's running a financial planning business, that you should pay a lot of attention to this, because from a reputational risk viewpoint, if anyone got access to your client's data and then began to do funny stuff with your client's data, access their bank accounts or anything else, it would not be a good thing to have happen. So, word of warning to everyone: look into Cyber Essentials at the very least.
Yeah, chilling words, and I'd thank you for that. Okie dokie, Ultra Wealth Giant on sale.
Okay, so this is the continued buying, selling, rolling up of IFA firms and businesses and wealth management firms. That the latest news came out that Evelyn, which is a combination of, I believe, Tilney and Smith & Williamson and a couple of other companies, is potentially going to be sold. The price tag is around 1.5 billion. And also in the same article, Cooper Parry were mentioned in terms of maybe their private equity owner is looking to sell them. So, yeah, I just thought I'd mention it if anyone's got any comments on it.
No. Private equity investors usually are running a fund. This is just reaching its natural cycle. It's, I don't know, they're generally 7 year, between 5 and 10 years, it would seem, but they're generally a fund, and the original investors want to have their money back and either reinvest it or get some liquidity of some sort. So I don't think there's anything either positive or negative about a big sale. It's just the look for and I have no doubt another private equity company will come in and take it off their
Yes.
hands
It's the
for that
business
price,
cycle.
and then roll it up again and sell it for double that in another 7
Are
years.
these consolidators, or are they running into difficulty? I know consumer duty is on our list for discussion today, but to maybe shoehorn it in, has consumer duty made it a little less attractive, a little more difficult to kind of mush them all in together, and maybe there's a much greater risk now?
I thought the valuation was a little bit lower than what we've seen in previous years, based on assets under management as a sort of crude measurement. But yeah, consumer duties had, I think, a big impact. Higher interest rates, various other things, but consumer duty and providing a better and better service, and not piling on additional costs for the sake of it.
I've heard that, again, somewhat after the horse is bolted, that any consolidator or acquirer now, as part of their due diligence process, is asking to evidence the fact that you have been delivering an ongoing service. They hadn't really asked that in the past in many cases, so they effectively bought firms with kind of, I suppose, an open-ended liability if you haven't been delivering the service. So now it is. But, it's all part and parcel of cleaning up the business, making it more professional, making it better. Guess what? You actually have to do what you promise you're going to do in return for the fee.
Scandalous.
Wow.
Scandalous.
Outrageous.
Much harder to do at scale, though, guys. That's the challenge that they're all going to have. So,
My heart breaks. My heart breaks for them. Okay, thank you for that. Back to you, storyteller. Monzo.
Just flagging something up. I saw this advertised the other day. Monzo, who many people will be familiar with, are a challenger bank, I suppose, one of these kind of newer startup tech banks. But they have woken up to the fact that there is money to be made from effectively consolidating legacy pension assets and putting them onto a platform and managing them. There's no doubt about it. Pension B have been a big success out of this. They got a full stock market listing a couple of years ago. Not sure if they make any profit yet, but nevertheless, they have scaled that business quite successfully based on, as I say, just organizing and consolidating historical pension accounts. So no surprise that Monzo have done it. Had a quick look at their website. Of course, all these companies, the website looks beautiful, just sort of nice, elegant, interesting, easy to follow. The fee structure, they charge 0.63%. Which 0.63%, which I don't think is overly cheap, put it that way. I mean, you could do the same effectively with Vanguard, their DIY approach, for about 23 basis points or something, for about a third of the cost. Someone like Vanguard would do it. It's, again, a couple of interesting points on this Monzo thing, having had a look at it. All the money goes into BlackRock. So they're the money managers. 80% of the funds are by default ESG.
Was that for ESG or BlackRock, Nick?
Both.
Choose your pick.
Yeah. So 80% by default. Again, I don't really get that, because you either love ESG and you want all your money managed by that, or you don't. And for them
Pension
to choose
B has
it,
got a big ESG slant as well. So
maybe they're targeting younger,
Yeah.
non-advised investors. Maybe there's a key theme there.
Yeah.
Other interesting thing, they say they automatically use target date funds. They said we will reduce your risk as you get closer to your retirement age. They're going to move them into bonds automatically as they get closer to retirement age. Of the fee structure, again, I find this fascinating. So they've gone with, because they disclose all this stuff, they've gone with FNZ as their platform, SIP provider, which again is interesting. I would have thought that our friend Dave Ferguson would have been closer to the action on this. That Seca would seem a more logical partner, because apart from anything else, the fee structure broken down, if it's 0.63, it's 0.45 is for the platform, and 0.18 is for the funds. It's interesting, isn't it? You pay double for the plumbing, effectively, than you do for access to the global capital markets. Pay twice the cost for just the administration. Interesting. Anyway, that was it. It's great having more options, more. What they do, though, is all you need to do.
It sounds like, is it though? It sounds like shit, doesn't it? I mean, as you said, Vanguard, you get on there for whatever it is, 20 pips.
I'll tell you what's quite interesting.
And they cap it.
Yeah,
they cap their costs as well.
Everything's nuanced. There's always some. They will do, according to, again, all I've done is have a quick scan through their website, but because they make it really simple and easy. Imagine the average person he's been for 4 different jobs, and they've got like 12 grand with one ex employer, 10 grand with someone else, and it's just a ball ache to try to organize it and structure it. And so Vanguard or whoever else, they expect you to do, I think, most of the grunt work to organize this. With the Monzo platform, you just tell them who you worked for and the approximate months and years you worked for them, and they say, we'll do the rest. We'll organize it, we'll structure, we'll get the money for you, chase it up, sign the forms. That's what they say. I mean, that's quite attractive. What you could do, you could game the system. You could get them to do all the work. And then once it's on there, I don't think they get any exit penalties, move it to Vanguard or someone else. Not that I'm encouraging that, but yes, interesting. But if nothing else, the comparison between like the average, any of us, an IFA type process, ours is by nature, it's very clunky and it's, filling in forms and sending stuff. And it's very manual. Their whole process looks really elegant, very attractive, quite sexy, making pensions sexy again. That was it. Back to you, boss.
Thank you. Okay, Wodge, client feedback.
Yeah, I just thought we kind of did an interesting thing recently. Got a client, kind of an ideal client of ours, in to do a testimonial video, which we used on social media, which was kind of a short, sharp piece. But then I did a little bit of a longer interview, shall we say, with them, just maybe 8-10 minutes, just for internal purposes, right? To basically ask him straight out, what are the parts that we do really well, that you value, that you really like, and maybe are there a couple of things that you don't like us doing or that you'd love if we did do. And despite every which way of me trying to push the conversation around to say, oh, it's the Metis Life plan and it's amazing, it was communication. It was just straight up communication. So it was like, look, the fact that I know you're there, that I know you'll answer a query. And he even said that, if there was, say, potentially some bad news or anything like that, we will address it and we won't ever shy away from it. And I kept kind of coming back around and kept asking him, and he was like, you've asked me to do this interview. I'm telling you what the answer is. He was just straight up. So I think the big lesson for us all here is make sure you're in communication with your clients all of the time. And it's not like, you're once or twice a year. It's if there's other stuff happening, or if they have a query, make sure it's dealt with really, really quickly, because he gets the comfort out of that we're his trusted advisor, we're on his side, because we will react to whatever he needs in a particular moment, as well as the stuff that we have scheduled, obviously. But it's more, if he has a query, and he doesn't have loads, by the way, right? So it's not as if we're over and back onto him every week or two, but it's when he does that we kind of front up. And then the second most important thing from his point of view was early doors with him. We suggested that he didn't invest money. And he said, I can't tell you how much the trust was built in that moment, because he was planning for maybe a business exit and all that kind of stuff. We said, no, that should not go into anything. That's short-term money. You need to leave that in the company and you'll get the tax advantages from it. So they were the two key things. We think it's all about financial planning and about, passive funds or whatever. It ain't. That's not what this particular client told me. And I think if people bother to go and ask their clients, actually sit down and ask them these questions. Number one, the clients are happy to help, especially if they're kind of long-term clients. Most people are nice and they'll be happy to help. And number two, they might tell you stuff that's a little bit different from what you think is really, really important. So I just thought I'd mention it because it was a bit of an eye-opener for me, to be honest.
I think that's really good what you've done, Carl, and it just reminds me that we don't do enough of it, and we should do. Most advisors don't do enough of it. I'm reminded of, I've mentioned him at least once or twice on this podcast before, a guy in the US called Dan Allison. And he's got a whole sort of script and process of feedback marketing. Go and speak to your best clients, sit down, and really important if you can, this face-to-face, not an email exchange, not even a Zoom call. Can I buy you breakfast? Can I buy you a cup of coffee? I just want to ask you some honest, and it's kind of, because you really value their opinion. We can't see our business because we're inside of it. You have someone from the outside. And I also think sometimes clients use certain words and language. You think, man, that is just beautiful. I love the way you said that. And if you ask permission, if they do, you're not fishing for that. You're just asking their genuine, honest opinion. If they say something really smart, they're saying it in like normal human language. We're talking about financial planning and stuff. And I say, do you mind that sentence? Can I use that on our website or something? He goes, yeah, it's fine. It's really good.
You nailed that one. You took the words out of my mouth. Like they describe. We have a way of making it complex, right? They describe what we do for them really simplistically. So it's like that's what, you know, if you're gonna do some marketing, they're the kind of words that you should use if they're the words that your ideal clients are already using to describe what you do for them. So look, I suppose the big message here is go talk to your best clients. Go talk to your most ideal clients. It will also, I believe, help those clients if you, as you say, if you ask for help. I think they become more on side, and you might get more referrals out of it as well. So interesting thing to do for sure.
Okay, let's bring the excitement level down. Storyteller, the new DFA Matrix book.
Am I the only one with any contributions this week? You guys have all been too busy.
It's not really a contribution, is it? We were just padding out topical tidbits, and this is just a bit of padder. So crack on.
At least I was padding. It comes up periodically, but I noticed it in my inbox this week. The latest version of the Dimensional Fund Advisors Matrix book has just been released, and it should be part of any advisor's toolkit. You can go online. You can speak to Dimensional. If you're a Dimensional user, you can get access to it. You can get a digital copy. You get a PDF copy. You can get hard copies sent to you. Our advisors often are using them in client meetings. It's just a useful piece of kit. It's quite geeky, but it's interesting for most people. And if you're not a Dimensional user, I think they'll provide access to you on the basis that they'll be open to having a conversation about their investment models and proposition. It's just a really good piece of kit. I think all of us, to one degree or another, have used it or referred to it from time to time. But as I say, it's topical because they've just released the latest version.
To the end of 2023.
Yeah, I know. They never do it quick enough for you, Carl, do they? But it doesn't really matter.
Yeah.
Time is an abstract concept. Don't worry about it. It's just another.
It does. But I will say there are a couple of pages that we use all of the time. It is seriously good data and really good to use with clients.
Yeah, just to hammer it home. Yeah, as a younger advisor, I spent hours and hours and hours in that book. I'll get the latest version. The best page, Carl. Are you talking about the world map page, Carl? Do you like that one?
No, that's good, but no, I love the various portfolios and the maximum drawdowns, as in what were over the last 20 years, what was the worst 1 year performance, worst 3 year performance. Because we're going to be talking about, 60, 40, 80, 20 later on. I think this stuff is really, really good to lead the conversation at the very outset that this isn't risk, this is the volatility. Yeah. But are you okay if this happens? But in the long term, this is what we're looking for. And that's all on one page. And it's a brilliant page. Really, really good.
Yeah, younger advisors definitely get a copy. I'd get a physical copy. Yeah. That's where you would learn it the most. There is a digital copy, but a PDF, but the physical copy is amazing.
Yeah.
Okay. Wodge, Metis Norway featured in something?
Yes, whilst I was away, the Sunday Times with Work L for Business launched their inaugural Best Places to Work list, and Metis Ireland were amongst those nominated. So for this award, you first of all have to fill in an application form and tell them all of the things that we do for our team here at Metis. And then they will decide if they push you into it's not bullshit, actually. And I'm very proud of this one. And I'm certainly going to take this one very seriously.
This award.
No, this one, if to get into phase 2, they send an anonymous survey to all of the team. And you have to score more than 80 out of 100. So this one you can't buy, you can't make up, and it's basically my own team saying this is a cool place to work. I've worked really, really, really hard over the last while to create a really good environment. And for me, as I always say to my own team, my job is to create an environment where high performers can perform highly, and I really believe in it. And I'm really, really proud of this one. And I suppose the challenge for me is, can we get on the list again next year? So this is a never-ending story, and hopefully, it's something that we can replicate again next year.
Was it ranked, Carl? Or was it just these 50 are decent? Was it like 1 to 50 or no?
No, it wasn't ranked. No, because it was in alphabetical order. But there was a kind of magazine in the Sunday Times, and they did a little profile on each of the companies, and they kind of highlighted the Metis piece, which was pretty cool.
Two points.
Good moment.
2 points to make. All your greatest successes in your business, Carl, seem to happen when you're away. Didn't it last year? When you were away on holiday last year, you had some great new business and great successes, hit some milestones. So
we also passed a significant milestone in terms of AUM, which is cool, but it is what it is.
All whilst you were away.
So,
that's the first thing. The second thing is, ever since we did the episode on awards, and the conclusion was they're not worth bothering about. We seem to win an award every week. We won the best podcast last episode. You've won this. Awards are rubbish apart from the ones that we win.
Yeah, but if you listen back to that episode, I did not say that. I do think that there is an element. I did say it that, if I was starting out, I would be applying for all the awards, because it does give you an element of social proof. And then as you mature, maybe there are some that are more important. And, this one was important to me as the team grows, because look, it means that we'll be able to do great work, but it also means that if we are hiring into the future, that people will go, oh yeah, I think isn't that the crowd that won the best places to work award? It's good.
And it was cheap in the grand scheme of things. You just gave each employee €500 for the anonymous. So it's just
don't anyone listening to this who's employed by Metis, don't get any ideas. That's not happening.
I can see it happening. I can say we actually the award, the next gen award that we didn't know we'd been entered into, and that we didn't even know we'd won until someone at the ceremony said we'd won. That trophy is winging its way back to us. So that will take pride of
where's it going to be kept? For North Watford
here, Lincoln Lodge. And then what I'll do,
where do you think, Alan?
I will occasionally
on the
get
box.
out
He just
and
writes
fondle it
Lincoln
live,
Lodge, Watford.
People
Lincoln.
I'm happy to pass it on once I've had a good squeeze of it. Okay, what is the next? Oh my God! Right, Smithy.
Yes, mate.
Nice and direct to the point.
This is very important. At the date this podcast goes out, it will mean as of yesterday, i.e. the 31st of July, every regulated firm in the UK will have had to file their report on Consumer Duty. Consumer Duty is 1 year old as an introductory piece of legislation. It's pretty clear that the regulator are taking this quite seriously. The challenges that the likes of St James's Place and others have had as a consequence of this means that their teeth are quite sharp, unlike perhaps some previous legislation which seemed to get announced and then quite quickly forgotten about. I don't know what you guys are doing, but Shireen, our head of operations, was telling me this morning that she's currently sort of completely busy making sure that we are filing our report, documenting it. We get some compliance support from a company called 360 Services. They provided at least a template. I'm sure other companies do. The template's 46 pages long, and you've got to go into detail about what you've actually done, provide evidence of what you've done,
waste of time,
submit it, and it actually, Nick, forms part of your RMAR, Gabriel, whatever it's called, submission, because we're also due to do that quite soon as well.
Well, I just did my year-end one.
Yeah, well,
the big one.
Yeah, that's prior to the 31st of July, though, isn't it? Because now we are, we're arriving at this 1 year anniversary, by which time every company has to submit that they've done something and have it proved that it was signed off at board level. I don't know if you haven't got a board, have you?
But there's a different deadline at end of July. Yeah. Aware of it.
So it's just, it's the thing. Fundamentally, it's a good thing, actually. I'm quite happy with it. Progress has been made. If it does sort the wheat from the chaff, it doesn't apply. I know, Nick, you don't agree with it all because you're doing
impactful.
It's impactful.
Regulation.
There is still
Hugely.
a tail end of this industry which is a bit scrappy and doesn't really do what it should do. And if this is helpful, if this clears it up, if this removes those handful of
work
cowboys,
for the good boys who do this stuff anyway.
It does.
Cowboys
It does.
just tick the
Unfortunately,
boxes. That's all it is. I don't know why you
is how
think
regulation
otherwise.
works. It's lowest common denominator. That's how it has to work. It'd be great to have different tiers of regulation, but at this stage we're all tarred with the same brush. But as I've always said before, Carl and I have spoken about this in the past. If you use compliance as a tool for your advantage, it's a pain in the arse, but you get it done, you systemize it, you move forward, and you feel positive about it. And should the regulator come knocking on our door, we've got a clean bill of health. Here's the work we've done, and we have done quite a lot of work. I think any firm who was, most firms were in decent shape anyway, but it may not have been superbly well documented. There may not have been a lot of evidence you can easily lay your hands on. So now it's basically good business practice. A lot of the stuff is good business practice. It's maybe it's a sledgehammer to crack a nut to a one advisor firm, possibly. But certainly the larger organizations have had to get more focused, get smarter about it, be more professional than perhaps they've been in the past. And as I always say, this is important stuff. This is families' life savings. You need to take it seriously.
How do regulators draft good business practice? They don't run businesses. So I cannot square this.
What should they do, Nick? Should they ignore it? Should they just allow people to do whatever they want?
Where's your TCF report file now, Alan? Is that in some drawer in the back room where you've got to update that all the time? In all the order of these things, where it's just nonsense upon
regulation
nonsense
and
upon
compliance
nonsense.
compounds. They don't bring out something new and get rid of something old. It's like everything that's been previously introduced is still there.
Yeah, I know. The previous
and
junk,
the new
no one cares about. No one
just
mentions
get added
TCF
to it.
anymore, but I'm sure we still have to file something somewhere every year, an affidavit with our blood saying we've done it. 0 complaints. How about that is the metric that matters, right? 0 little churn. How about having some real metrics? Anyway,
I'd have a different view. I think the corporate governance and compliance in this business has been sadly lacking in Ireland, in the UK for years and years and years. And if we want to be considered a real profession, like the legal profession, like the accountancy profession,
we're way better than them. We're different
we got to step up to the mark, and we got to, there's some stuff that just needs to be done. And I couldn't agree with you more, Alan. People who take this stuff seriously and who, commit to the highest possible standards in this, I think you're setting yourself apart from your competitors. And I think, getting these kind of messages out, and we started to do it to your own clients, I think will, build that trust with your clients. So, yeah, I disagree, Nick, I'm afraid.
Okay, well, we'll agree to disagree on that, because I have a fundamentally different. And there's nothing. All of us have really good businesses, and Metis and Capital are bigger businesses. There's nothing in Consumer Duty that's going to change the way you do your work, your fundamental work. Nothing. You might be able to advertise that you do it a certain way. Great. Why you should have to, I've got no idea.
Might guide our systems and processes a little bit better, more streamlined, make sure. I guess one of the worries for a regulator would be, if Alan has 10 different people offering advice in Capital, do they all get, broadly speaking, the same kind of service and results and outcomes? That's really important, so that you can't have any loose cannons in your business. And I think certainly for us, it has been a massive help for us. I know everybody gets the same types of outcomes, albeit there's individual styles with various individuals, but I think it's a good thing.
I have to say,
for sure.
We always talk about evidence-based, and things should be evidence-based and not guesswork. And again, we've mentioned this, I mentioned it on this podcast before, thematic reviews and stuff that FCA has done, and they ask for data from a random bunch of companies, small ones, big ones, everything in between. I can't remember the stats, but they were pretty poor. 60% of companies hadn't done whatever they were supposed to do. There's a bunch of stuff out there. And so if that is the case, if that is factual and evidence-based, there's a lot of work to be done. And if the regulator is providing a framework to encourage, they don't seem to be really coming down with, size 10 boots and smashing everyone. They're saying, look, for the time being, we're going to work collaboratively together. We're going to organize things together for the good of the industry. So, but the facts are, you only see your own business, and in your opinion, you run it super well. But the evidence seems to be there's quite a high number of firms that aren't meeting minimum standards. So we're trying to
And those
improve it.
firms will continue not to meet minimum standards.
Not
and just
if
be a
they are,
property
not if they're
By the way,
getting
Carl, I'm
dear
glad you're
CEO
enjoying
letters.
Consumer Duty. I didn't even know it launched in Ireland, so that slipped under the radar. And I'm glad you're embracing it.
You don't have to wait for a piece of legislation to run a good business.
Correct. You can go and do best practice.
Okay. All right. We'll agree to differ. Right. Wodge, Morgan Stanley.
Yeah, I put this one in because we were struggling for topical tidbits, so this will be 10-second job.
I think
Some
this is a
dude
good
from
one. This is a good one, Carl.
some dude from Morgan Stanley said we should brace ourselves for a 10% correction in advance of the US elections. And it's behind a paywall, the article, right? So I read the first 4 lines. There was no chance I was going to pay to go in and read that article, but it was like mother of sweetest divine Jesus Christ. Like that person and or Morgan Stanley, and must have gone through their compliance department, has decided, let's put this out there. I have absolutely no idea whatsoever if this is going to be right or wrong. We'll just ignore it if it's wrong. And sure, if it's right, won't we seem like geniuses? Active fund management. Oh, my mother of sweetest divine Christ. Will you give us a break, please?
Yeah, no,
Yeah,
I quite
same.
like these articles because it's people publicly showing that they're investing illiterate. So the market's declines, as we know, regularly every single year. Minus 15% is now. So he's basically, stating a historical.
You're stating this
fact
happens
as
every
of
single
now.
year. Peak
Yeah,
to trough
basically,
decline,
the-
intra-year decline.
If
Every year.
he said, I think the market. If he said, I think the market by the end of October is going to go down by minus 63%, and I'm dead sure about it, I prefer that person.
Yeah.
When they're just mentioning something that happens every year as regularly as your birthday, it's ridiculous.
It's a quiet news cycle.
So I love it.
It's the summer.
That someone
It's
who's highly
just
paid,
dross.
highly intelligent, highly experienced, publicly declares that they're an investing illiterate. It's brilliant. I love
The
it.
great thing about the internet is these things stay forever, don't they? All these great predictions that were made. Remember that one? And it was a good few years ago now. It was the Bank of Scotland, the Royal Bank of Scotland. Remember, Nick, you saw it. And it was
Yeah, I've got that one in my. I've got that
got
one
a
in
little folder
in,
of things to be
Evernote.
brought out every
Yeah.
now and again. And I can't remember. There are so many predictions of doom and gloom, which so far, and eventually, as we all say, they will be right. There will be a massive correction.
Well, haven't we got that famous one who's a consultant in our business that said like the market's screamingly too high at the moment, and it's literally gone up like 140% since then.
Alan is tracking that as we get the graphs from time to time.
Yeah, they just comes out.
I absolutely love
But what was the
seeing
phrase?
I mean, how could they say something like
what was it,
that?
the stupid advisors or something? Some very derogatory.
Financial advisors always telling you to stay invested. Now's a good time to get out of the market, and literally
Yeah,
market's
yeah.
130% since he did that post.
He'll be right eventually. No, he won't actually. He can't be.
Why
he
would
can't
you be
be.
that
He can't be.
insane to
I know.
publicly stamp an opinion?
Well,
that
to
you know
say
in
that and
hindsight
to have
should
make an attack,
Conviction.
to make an attack on people who have
whole
who are in the
profession.
arena, who have got the qualifications, who are dealing with real clients, who are putting their money where their mouth is themselves, and to say these advisors are all was it the dumb and something else, some
Yep.
phrase. It was awful, but it will
Yeah,
not
it
be
was dumb,
forgotten
yeah, dumb
about.
was
We'll
dumb,
make
yeah.
sure it's never forgotten about. Actually, as it is a quiet news week, brings something else up which is not on our docket. It's always quite interesting. A close personal friend of mine, true story, Eddie Jordan, the ex-Formula One racing team owner. I don't know if you saw that in the press over the week.
He's not declared himself bankrupt, is
No, far from it.
he? Okay.
He put, he's a very wealthy guy, put a chunk of money. He was advised by his private bankers, which again is all public domain. Just look it up. HSBC, who's banked with for years. And they advised him to put the thickhead 46 point something million, so nearly 50 million pounds into an investment. And all he was looking for was low risk, safe,
Wealth preservation.
And there's a lot of these things around kind of cash proxy type funds. So this was supposed to be, it's going to keep your money safe. It won't go down. It won't make you a particularly high return, but you'll do okay by it anyway. Inevitably, it's all going tits up. He's taken them. He's in the High Court, I think, this week, suing the advice that he was given. And again, you read through the article. I mean, it's it's comical in a way, albeit it's sad. For somebody who wanted something safe and secure, it's something they call it a floating rate bond. It's a bunch of different underlying securities and bonds and trading of different derivatives.
Is it 100% capital wipeout?
No. It's
declined in value.
No. It's declined in value. It's done.
It hasn't done as well as
it's done.
expected.
It didn't preserve capital. He lost 5 million. He's suing them for £5 million.
Fine.
But they've asked, and of course these things, and it reminds me a little bit of the previous Aberdeen Standard Life GARS fund, which again on the surface it all looks great. Preserve capital, give you a high return or a reasonable return in any market. And it's similar to this because this HSBC bond account, it had investments in, amongst other places, China and Zimbabwe. So that they're the bastions of safety and security from a financial viewpoint. And
this sounds a little bit like that. Do you remember that case I brought up a month or so back, where that financial advisory firm were found to be, selling these safe bonds, and it all went pear-shaped as well. So it sounds pretty similar.
It's similar.
But floating rate
bonds, floating rate note, but yeah. But
Right.
it's yet
Explain
another
that one
example
to
of
me.
a theme that we keep coming back to is the wealthier you are, the more complexity seems to get shown to you. If you just said, put this in whatever, in some sort of government treasury or national savings type account or something, which is just a cash account, you're going to make nothing, but it's pretty safe.
Yeah.
But no, I have no doubt. Imagine what it would be like going to HSBC in Canary Wharf up in the executive suite and just being pitched something rather, saying this is safe and secure. And even the very wealthy, they tend not to be financially sophisticated in these types of products. And so, but they meet a nice guy and he's wearing a nice suit and they pitch it to him and he goes, that sounds great. And anyway, it's ended up in court. If I was HSBC, I'd have just paid him, given him 5 million quid and keep it his now. I mean, they are.
It's a rounding error for HSBC.
Yeah, it is. And it's not going to do them any good whatsoever from a publicity viewpoint. But anyway, that was just an extra one added in. That's just hot off the press in the papers this week.
And
Good one. I like it.
And even this very day, there's wealthy people sitting in skyscrapers all around the world being sold a load of other guff that in 3 months, 6 months, 9 months, 3 years will turn out to be financial trash that they should have avoided. But again, shiny suit, wealthy people, more lies.
I did a post on that.
Rinse and repeat.
I did a post on that on LinkedIn, I think, last week, or the week before when I was on Holes, about this, just keeping, a big part of the advisor's jobs, keeping clients safe from trash. There is so much trash out there. And
we read about all the trash and our job is to protect you from it. Like, we're aware of all this crap to protect you from it. Like, that's why I'm reading about this crap.
And I've certainly met in real life some very smart, seriously smart, intelligent human beings who have been seduced by some of this stuff, and they've lost. One client in particular, one person I know, lost £1 million, pretty much wiped out that amount of money, never going to get it back. It was a fraud, and I do think that is a significant and kind of sometimes not particularly talked about very much, because we talk about the things we do. We advise you to invest in simple, low cost, highly diversified, but what do you tell me to avoid? What are the things that, with your expertise, knowledge, connections, contacts, you can keep me safe from? Because a lot of this stuff, again, back to this idea of we're dealing with human beings. Even the smartest people are seduced by attractive sounding offers, and particularly, usually men in nice suits with with a nice smile and a charming way of being, and it sounds too good to be true. Fabulously, where do I sign?
It would be so easy. It would be so easy to sell these schemes and scams. It would be shooting fish in a barrel.
They are optimized. They are designed. All the words and the language and everything else is designed to be attractive.
People are always looking for something new, shiny, exciting. What's the returns? Is it? Yes, guaranteed 14.9%. Yeah, it's just shooting fish in a barrel.
While we were just digressing on that very interesting subject, I opened up my Evernote and went into my forecasts folder. So Morgan Stanley said brace for a 10% correction. I wonder if the chap at Morgan Stanley who said that was the same guy who at the end of 2022 said new stock market low coming in 2023, according to Morgan Stanley. US equities are set for their worst year since the global financial crisis. And according to a Morgan Stanley strategist, Michael Wilson, corporate profits are about to meet the same fate. Plus ça shows, plus c'est la même chose. It's just garbage, isn't it? But if you store
Surely
these things,
he's
you
got
can
to
come back
lose
to
his
them. And I've got a
job,
whole...
but he won't.
Isn't that crazy? Morgan Stanley, huge global investment bank,
got
and
to
they're-
lose his job,
they're
but
going
he
public
won't.
on this junk. It's crazy.
Yeah. Yeah. Okay. Listen, chaps, we're at 50 minutes more or less. So let's do the final topical tidbit. This one's from Storyteller.
Yeah, no, this is just just pointing things out. It was a kind of rehash, and I updated a post I did. All of us get contacts from young financial planners, Trappists, people who listen to the show and they want a bit of feedback, thoughts, ideas, suggestions, how to progress their career. I wrote something, posted it on LinkedIn and Twitter, and it's available. So we posted if you didn't see it, the link is in the show notes. I hope it's of some value to someone out there. I thank you.
Okay, thank you very, very much. Okay, so Ultra's screen's gone off, but I think his microphone's still on. So if his roommate is going to the toilet, this could be some interesting background noise going on. Let's move on to what many people call the meat and potatoes of the show. And for episode 50, we've got a bit of a doozy for you. We want to kind of address this subject and make this episode the reference point for this subject. And this was inspired by one of the many tweets that Storyteller was sending while he was on holiday, notionally with his family, but really just glued to his phone. And this was about risk and volatility and so forth. That's the essence of it. And Alan said, if we can persuade clients to go in from a 60-40 or even go for a bit of 50-50 into a 70-30 or an 80-20, and then help them stay the course, the value we add, not just for the clients, but for that client's family, in terms of children and grandchildren and so forth. The value is just immense. And it brought up a whole lot of some views that were very much applauding what Storyteller had said, and other views that looked to him askance. One IFA lady said, "Is this a joke?" So, and of course there'll be links. There'll be links to this the tweet in the so-called show notes, and also a link to the LinkedIn reposting of it that I put on LinkedIn under the Trap brand. So, Storyteller, where do you want to start with this one?
Well, I thought it was time we kind of nailed our colours to the mast clearly and create something. We just have a conversation for the next 10 minutes or so that we could perhaps point people to in the future, because this is a perennial subject. We go round and round every time. And what happens is I see some chart or something posted and I think, oh, that's quite interesting. And it was a chart, actually, again, our friends Dimensional had produced. And all it was, I think, 60-40, 80-20, a few different portfolios. And again, going back over a meaning, I can't remember exactly, but a meaningful time period. And I was quite struck by the difference between a 60-40 portfolio. And again, all the caveats about whether it's global S&P, whatever, but as a thought experiment, a 60-40 portfolio and an 80-20 portfolio. In other words, you've got 80% of your investments exposed to equities versus 60% exposed to equities. You would think intuitively it wouldn't make a huge difference. You'd expect over the last, certainly the way the equity bull market has been in existence for the last dozen years or so, you'd expect it to outperform. But the impact was really quite significant and really meaningful. And I thought that's quite interesting. If you were able to, as an advisor, again, caveat all the other stuff, provided that you've done all your homework and the client's comfortable with it. If you're able to say, rather than do the default, which is a default in our sector, 60-40 portfolio, can I encourage you to think about moving to an 80-20 portfolio? The impact is significant. And as often is the case, I get slaughtered by a bunch of people. But yeah, the interesting thing was quite a number of financial planners. Yeah, that some lady financial planner also said, I don't know, it was just, is this a joke? And you kind of don't understand it. And I don't know, said something else, can't remember, but pretty derogatory, really. Personal attack. Fine, I'm used to it. Hang out with you boys. But I thought if we could just go through, and let me lead it, because if we could just maybe raise amongst ourselves the questions and the pushback that happens during these conversations, because I think fundamentally the four of us on this are broadly in agreement. I don't think anyone's violently disagreeing. You should hold as a long-term investor, you should hold a higher proportion of equities than maybe 60%, subject to all the caveats. So let me just pose a couple of questions, and maybe I'll just go around the house, if you like, and just get your views. And anyone feel free to chip in, and we can use this as a kind of template or a model for others who disagree in the future. So one of the questions, I think this lady might have said it, or someone else said something along these lines. But what if a 60-40 portfolio gives you the expected returns needed to satisfy your financial plan? You understand this? So Nick, you understand what the question is? If you can achieve what you want to achieve, i.e. you'll be on course for a successful retirement with a 60-40 portfolio, why would you do anything other than that? What are your thoughts, Nick, on that?
Well, to be fair, that is one of the best questions you can be asked around this, I think. We all believe, and I'm sure the vast majority of Trappists believe, that the financial plan comes before the portfolio. It's the financial plan that determines the rate of return that our clients and our friends are going to need to lead them to financial salvation over a typical 3-decade retirement. And for some clients, perhaps the 60-40 portfolio will, net of fees, generate a sufficient return over and above inflation, a real return. For many clients, it won't, flat, so that argument, you can knock them to a cocked hat. But I also think, because we believe in the long-term advance, and that the declines really are temporary and the advance is permanent, and permanent loss in a beautifully diversified portfolio of the great companies of the world is not a market phenomenon, it's a human phenomenon. And if we can control the human behavior, why would you not, for your clients, want to give them the chance to create something, a legacy of meaning, not just dying at 100 with £1 in their pension pot because cash flow says, just building something that's just could be something that could be passed down to children and grandchildren.
That's a great point.
And or for those clients who've got that charitable bent to them, want to do stuff in their lifetime with foundations and endowments and giving money away. Well, here's your chance to build something to give away with a warm hand in your lifetime. And I think we've internalized this argument that actually, the long-term real return of equities over bonds is a significant difference.
3 times
Why would
higher
you not
equities over
give
bonds?
people the chance to benefit from that, and for us to stand as the bulwark between our clients doing the very best work for our clients and all the nonsense that Morgan Stanley being the classic, just being like holding this up to the eye of Sauron. For those listening, so mean nothing to you, but I'm holding my hand up to that video camera now, saying, "No, back off. We're not in this world. You're not welcome here." As a firewall between our clients and the nonsense. So that would be my argument too. But in a short response, 60-40 ain't going to cut it from a financial plan point of view either. They'll need the extra 1% potential return that's there, compounded over 30 years to get them to where they need to be.
Andy?
Yeah, just following on the same point. Yeah, the real return from equity over bonds long term is 3 times as much. So we know that equities are the superior wealth building asset class. The other thing, the most detailed, complicated, accurate financial plan doesn't factor in the unknown. So what I mean by that is, let's say the plan gets them over the line with X 100,000, X million still there, as in, the people out, the money outlasts the people. It doesn't factor in the unknown. So I'm okay investing in creating a bit more wealth for the unknowns. So the unknowns are their kids get divorced and they're going to be kicked out of a house and the school that they want, et cetera, et cetera. The grandkids they want to put them through private school was originally, that wasn't the plan. They get divorced. Mr. and Mrs. whose clients, they get divorced. Or a medical situation rocks up with the clients, with the family. So the most accurate financial plan doesn't factor in unknowns. Yep. So I'm okay creating wealth for the unknown. Obviously, caveats within reason. But switching the equity portfolio, there's no behavioural change. It's just a temperamental change. If I say, let's create more wealth for the sake of it, you need to increase your contributions by $3,000 a month. That's ridiculous, because that's actually going to change and impact their lifestyle. I'm saying your money's going to be invested. If you leave it in cash, you're going to run out of money. If you do a 50-50, there's a chance you might run out of money. If you do an 80-20, it's a temperamental change, not a behavioural change. Your lifestyle's not impacted. The idea is don't look, don't react, etc., etc. And these people that mention things on Twitter, just say to them, did your clients lose money during COVID? Did they lose money? Can they even answer that question? Because they'll say, yes, they did lose money, but then they didn't. No, it's like, no. There was a temporary decline, then the market continued. That's another point. Carl, over to you, my friend.
Yeah, all valid points. I think that dimensional page that I spoke about actually is a really good way of setting kind of the tone with particularly with new clients. And you're talking about, as you say, Nick, we always start with the financial plan, so you can identify the short-term money. I like the idea of short-term, medium-term, and long-term, and I think maybe there is a bond element in the medium term.
Yep.
And as you guys know, I'm probably more okay with a bond element than some of you guys would be, and I think that's okay. So but I think that dimensional page showing, look, we're always saying it, risk versus volatility. It is volatility. And we got to, if we show you this now and we tell you this is going to happen, but here are the long-term returns, I think that's your best way of successfully investing. Andy, you have a phrase, I can't remember it, but it's something like what you just said, but you're okay with creating wealth. It's like we shouldn't shy away from creating wealth. So like if something is clearly long-term investing, so a lot of clients' pension funds would be the way they're structured in Ireland, that you can pass them on to your spouse and then your kids and whatever. They're going to be there forever, and they're going to live way beyond you. That's equity investing. Like, there you go, all the way. But I'm okay with having some bond content there. I would, if it was me with many millions, which I don't have, but if I did, I would have some bond content in there. But certainly I wouldn't have my overall portfolio at 60-40. That's for sure. I'd be much higher in equity.
40% is a high proportion of wealth to be held, knowing that there are better returns, albeit subject to greater volatility, particularly when most people have got other assets. They've got cash, they've got property, they might have other stuff, which is less short-term volatile. The key thing here is wealth equals freedom. And who doesn't want more freedom? Why would you not want? Why would you want to just get
100%,
the minimal amount of freedom that your financial plan, which again, as Andy's talked about as well, it's ridiculous to assume. It's naive to think that we don't need to do any more because 60-40 gives us enough and we die with zero or something. Okay, well and good. So there's no safety net. There's nothing else in place. And if some of the issues, and we've talked about this in the podcast as well in the past. Classic financial
life throws curveballs, doesn't it? So
the financial plan doesn't take account of those, not really. And why wouldn't you want an extra safety net? Is kind of the thing. So that's maybe we've addressed that. One other thing I've just thought about briefly as well. It's kind of this idea about inflation. You need to wealth needs to be preserved in real terms. The cost of living is going up. Don't always believe the kind of prevailing rate that we're down back at 3% inflation or whatever. Inflation's highly personalized.
Yeah, rubbish.
It's highly personalized. Yeah. And a lot of people sort of, as they get older and going to retirement, I just think about my own circumstances. Some of my biggest expenses are things like travel. I like to go on good holidays. The cost of our holidays has gone up a lot more than 3%, I can assure you. School fees.
Ignoring VAT,
school fees go up
about 7 to
10% a year. School fees, and food costs. Family food, that's gone up a lot more than 3% and continues to rise as well. So if you work out your personal inflation rate, particularly for those retired who like to go on holidays and things like that, and want to maybe are part funding or helping children or grandchildren with school fees and some other costs and expenses, you tend to find inflation is more like 7%, 8%, 9%, something like that.
A personalized inflation rate. I love it, Alan.
Well, you could.
Love that because,
but also, I've gone to try to see if there's any online tools. Okay, be wary, be careful about this, because I plugged my details into the BBC. Have got a version of this, and it's bullshit. So you either just, okay. Did you spit out whatever you're eating?
I had a mint. I was just sucking on a mint and I almost spat it out, which is
his false teeth.
So be careful about these other sort of. There might be. I didn't spend much time doing it, but I know for sure we've all got. Well, depends where you spend your money, but a lot of people going to retirement have got. You just go. Well, I'm beating inflation because inflation is 3% and I got 6%. Well, not really. Your personal inflation was 10. You actually lost money in real terms, particularly if you've got bond exposure. Nick?
I'm just going to do it. I'm going to do a first on Trapper. I'm going to share a screen. So I'm not sure how this resolves at your end. And obviously, if you're listening to this, it will mean absolutely nothing. So I won't dwell on it for too long. But let me.
Ooh, well done.
How does that come?
That's
Can you
good.
read that
Yeah.
tweet? That was the tweet from the lady who said, "Is it a joke?" Okay.
If it were this simple, why bother with an advisor? Oh my God! I think that's the point. The point. Well, look, This is not unlike some of the people who commented on me. This is not a personal attack. We want to be here as a community, kind of all help each other, support each other. The four of us on this conversation, we've arrived at our conclusions, rightly or wrongly. Obviously, they're right. But some of the other conversations, some of the other pushbacks. So let me give you another question, or something else that I noticed on the comments box, which was, let me see, Carl. I'll throw this one at you, because I think it's Andy. Andy, can you mute?
You're in twice, Andrew.
What are you doing, Ultra? You're in twice.
You need to mute.
We're losing you. Steve Austin, the $6 million man.
God, it was.
I can't mute it.
It was
I'm
all
used to
going
it.
so well. Yeah,
Andy, turn off your microphone, mate.
shocking. Carl, the voice of reason.
Yes, go for it.
So someone pushed back. I said this, 80-20 is better than 60-40. What about clients who need income now?
Yeah, so look, we've been now. I am very straightforward on this one. I know there's all this setting up portfolios with income producing, blah 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 blah. Right? That's what financial planning is about. That's why financial planning is a process, right? It is not a one and done, and that's why every year when you're sitting down doing your annual planning meetings.
Carl, I'm really sorry. Carl, I'm really sorry.
Yeah.
I got an error message from Riverside saying Ultra's browsing is preventing recording. Ask Ultra to refresh the page. Sorry, Carl. I had to.
Okay.
Also, you're in the meeting
God's
twice,
sake.
Andy. I don't know if you can kick yourself out.
What did he do?
Yeah. But I think I vote for.
I'm
now on
having
for
a nightmare,
holidays.
Nick.
Yeah.
Can you hear me?
Yeah.
Yeah, you're okay.
Okay, my battery's dying on my laptop because I've got the wrong freaking charger. I know my phone, so I might have to bugger off. Is it doing anything, Nick?
I don't. Mate, do you want to leave? Do you want to leave completely and come back in? If you want to come back
Have
in,
you
but
not got
leave
a charger
completely.
with you?
No, I've had
Let's
to buy a
not,
charger
let's
from
not flash
the
this out
Apple
because people
shop.
listen to this nonsense. I'm not editing it. So can we just leave? You're present in the meeting twice, Andy. So if you can get yourself
Okay,
out, otherwise I'll
I think
kick
I'm
you.
going to have to bugger off.
Just come out and
luck,
come
guys.
back in again, and let's move on. God. Yeah, this.
Okay.
Yeah, Carl,
So,
talk
anyway.
about the art of financial planning.
Financial planning being a process that you look at every single year, and therefore the beautiful software that we all have for financial planning can look for the next 2, 3, 4 years, whatever you decide is right for your business, what your house view is in terms of what cash is required. And that's also another reason, guys, why I like to have your short, medium, and long term. Because if you have your medium and long term, you will have some bond content in your medium. Now, for medium, for me, it's kind of 7, 8 years. Okay, so and then after that, it's equities. It allows you then decide where you want to take to top up your 3-year cash. So you could go and take it out of your 60-40, your 80-20 portfolio. Or you might decide to take it out of your equity portfolio. But now we've got loads of different things going on. So, yeah, I can't. I'm like, when I used to think about this at the outset, when people were bringing in all these, the 4% rule, and you need to have your guardrails in place. I'm like,
God,
what am I missing here?
I think we all thought
Am I stupid? And I'll be reading this stuff and saying, no, it's still.
They've never advised a client.
It never made sense to me, and you're adding complexity that's not required. Just invest in the global stock market, and if you wanna, you'll have your short-term liquidity, and if you want to add in your bonds, which is certainly the house view in Metas, that's fine. That's all you need. You don't need anything else.
Look,
you do not need anything.
Go on, Nick.
Sorry. So I mean, in accumulation, or what human beings call the saving stage, I pretty much moved to all my clients being 100% great companies of the world, because it doesn't matter. They want volatility, right? They want this pound cost averaging. In the spending stage, what people who don't do our job call decumulation, in the spending stage, I will have the short, medium, and long term portfolios. And funnily enough, when you combine them all together, it comes in at about an 80-20 or an 85-15 portfolio anyway, when you look at everything in the round, because you do have a place for bonds there for short-term needs. You know, it kind of comes back to 80-20 anyway, naturally in saving, if you're doing proper financial planning. Sorry.
Yeah, and look, so you've asked two questions there, Alan. So if I can just kind of reiterate a point Nick made, I think the first question is valid. I do. I think it's worth a discussion around, well, if a 60-40 is going to give me what I need, why would I go any more volatile? I think there's a discussion piece around that for sure. But I don't think if someone is in, needs an income because they're in decumulation, that they need to be invested in something else altogether different. I do not believe that.
I'm sorry to say it, but I can't remember who said that, and I think more than one person said it. It tells me that they don't understand the fundamentals of real financial planning. That is kind of one of the most important things that we do, is managing liquidity, managing income needs, expectations and requirements. And as we've said many times in the past, it is an art as much as it's a science. It's a blend of both of them. And that's where the value lies. Just to say the person needs income and assuming they're just going to take it directly from an 80-20 portfolio, just cash in units to pay an income, I'm sorry, but it tells me that you don't understand the real art of the work that we do.
Yeah, and Alan, you can go a step further. They don't understand the long-term nature of successful investing.
They don't. There's a lot more work and education needs to be done. And
these are fundamental items.
They are to us, aren't they? It's amazing. That's all part of life's rich pageant. We're such a broad church.
Yeah, it is. Look, another question or pushback was, yes, but what if the next 30 years are different to the last 30 years? Right?
Well, we won't know. We can't know. We cannot know. So what do you want us to do? Make policy on the hoof?
And
guesses?
That's the response. So what should we do then? History is the only guide we've got, and we have got more than a century of history, which does cover world wars and global catastrophes and everything else. And there may be more of that in the future, God forbid. But what else do you do? But use it as a rough proxy for what the future might look like.
But Alan, bond yields are higher. Haven't you seen? Bond yields are higher.
This time is not different. This time will never be different. It won't ever be the exact same, but history has an awful habit of repeating itself. But what we're asking people to do, what we're asking our clients to do, is to invest in the human race, the ingenuity of the human race. Are we always going to try and be progressive? We are. That's what you're buying into. Be optimistic about that into the long term. We are in the best place ever. In history, we live in the best place ever. What's that one? The rational optimist. Yeah, exactly. And what my grandkids, just like I'm in a much better. I live a much better, easier quality of life than my grandparents. My grandkids, in turn, will definitely do the same.
You just spent a month celebrating your 50th, so there's no arguing with that, my friend.
I did, and you know what? I loved it, and I'm not sorry at all, and I'm feeling very grateful, and I believe in the human race. Be optimistic. That's the way you just have to be.
Can you imagine the technological advances and medical and all the advances over the next 3 decades? It's going to be extraordinary. And you want to participate in that?
You have no idea. You have no idea about the leaps and bounds Ireland has gone through in the last 50 years, right? And the UK was probably much more sophisticated. So you guys haven't seen the huge improvements in lifestyles. So I've seen it. I've lived through it.
But
come on, onwards we go. And they'll also see that I was deeply uncomfortable with the content of some of today's podcast, owing to the Irish versus UK cultural differences. That just cost us money we don't have, Nick.
I know, demonetised yet again.
You had a question,
Go on, Alan. Hit us with some more.
Nick. But what about Japan?
What about Japan? I mean, that is... Was that actually
I think I added that one, but that was one often that one gets brought in. There's one guy, again, shoulder me. I've actually muted him because I can't deal with it anymore. It just does my head in. Every time I post anything to do with any, markets, S&P, anything else, but what about Japan?
Well, that is actually a really good advert for what we do, because what about Japan? What if you put all of your money or your clients' money in not in just one asset class, equities, but into one country's equities? Well, we wouldn't do that in a million years, not because of the Japan experience. We wouldn't do it full stop because that's taking a massive geographical bet. And we're not doing that. We just say we want to buy the world. We want to buy human ingenuity wherever it may be around the world. And we don't try and guess where the next hot spot is or what the next hot sector is. We just buy human ingenuity en masse. So, yes, Japan had that awful 30-year... There's nothing about Japan as well. It was a completely corrupt and rigged Nikkei in 1989. I mean, it really wasn't. It took decades to unwind that. So it was a bubble of bubbles. But, yes, we don't... What about Japan? Absolutely right. What about Japan? We don't want Japan. We want to buy the global market. And, yes, the global market will have severe temporary declines sometimes that will give our clients the willies. And we're there to say, hold the course. This too shall pass. And everything will come back to where it was and then go on to new plateaus. But you mentioned Japan, absolutely right. We do not do Japan. We don't do the USA.
I suppose you could say, but if you global market cap weighted, you are 60%, over 60% US, 65% US stock. That's quite a big bet. But what else can you? What else are you going to do? Anything else is a...
What else are you going to do? We don't. I mean, we know some IFAs in the southwest of this country apparently have a crystal ball, don't they? And they spend all their time looking at incredibly complex charts and things because they're just gifted, but we're not. But one of the points we talked about was the Mag 7 dominates the market, and it does absolutely. And maybe the values are too high, too risky. The one thing I would say is that if you have a portfolio that is tilted towards certain factors, small cap perhaps in value and perhaps momentum, that when we have these significant bear markets, those kind of portfolios, for whatever reason, for whatever technical reasons, tend to ride out better than a pure cap-weighted global equity fund. So you can even, to a degree, ameliorate that stock concentration risk, which is a real and present danger. I get that.
The thing is, you've got to do the work personally to get this, to understand on the investment side of things. I mean, I've talked in the past, I think, on this pod about when we kind of saw the light after 2009, coming out of the great financial crisis. And I was just thinking, what the hell? This does not make any sense to me. And so we spent such a long time. And I now feel quietly confident that we're doing the right thing. We are optimized. I think every one of us on this pod, and quite a lot of listeners, have got what I would humbly refer to as a world-class investment portfolio based on rigorous data, facts, evidence, and science. It just exists. Is there a better way of doing it? I don't know. Maybe, but not that I've found. And we leave no stone unturned in our quest to continually tweak, enhance, or improve our investment strategy. And if you combine that with the behavioral stuff and the uniquely human stuff, it's about as good as you can get, really.
Yeah, and the other thing, Alan, I'd say, like if you've been on this journey since 2009, you're ahead of me, right? But you should get great comfort from the fact that in 2009 you dealt with the historic data and you went evidence-based in 2009 on this is the way forward. You're 15 years in of proving to yourself every single day this works.
Exactly.
Right. So it's not like that. I'm hoping that the historical data, you are actually living proof that this works.
So 2009, when we first started our journey, and it took a year for myself and my colleagues to go through this.
2008.
2008. Well, 2009 is when the market suddenly finally recovered.
Yeah, but I'd made that switch.
But we were all kind of, we navigated our way through it, but we were all quite, I suppose, shaken up by it because we trusted these so-called experts. It's well documented. I've spoken about it in the past. Outsourced a lot of investment management to Nick's friends at what they call Posh DFM. Or the equivalent, and but the point is, it's like a lot of things in life. It's you've got to do the work. If you think you can, I don't know, read a couple of articles or even go on the DFA foundation course, and you think you found the salvation and solution, there's no shortcut to this. You have to. I do feel now one of the few things I do feel very confident about in my life. If I sat down with a prospective client and they asked me to justify our thought process and why we do what we do, I would be able to confidently articulate and even share the journey that we've been on, why we've done it. And I'm just saying to anyone listening to this podcast, this episode is not a quick fix. This episode should encourage you to go and learn more. Do anything in life. You can't borrow someone else's experience. You're going to have to do it yourself. I think.
Yeah, like another way of putting this, right, is you've done the evidence-based research. You've looked at what's the best for your clients going forward. And anybody, say our Morgan Stanley friend who said, prepare for a 10% correction in the market, or your floating rate note bonds or whatever, right? So take your own life savings and you have three options, A, B, and C. You're going to go into long-term, buy the whole market. You're going to put your life savings with Mr. Morgan Stanley because he said it's going to go down 10%, or you're going to put it into a floating rate note bond, right? And I'd ask Mr. Morgan Stanley man which option he would go for. And I know it wouldn't be the gamble that between now and the next 3 months, I will.
Which is the other thing as well, which everyone needs to be wary of, and our clients need to be reminded of, is that all these people with their forecasts and stuff, they've got a different agenda. They're not worth listening to at the best of times. Correct. They don't understand your circumstances. And also get that clearly has achieved column inches. We know for a fact if you predict anything, particularly doom and gloom and negative, you are likely to be picked up by the press. And eventually some of the stuff, that's the point, they will be right. Oh, Mr. Morgan Stanley predicted 10%, and 10% surely came along. If he says it often enough, that will happen. But it's an entirely different.
It's correctly called 10 of the last three.
But it's an entirely different thought process and agenda. And one thing that I will say as well as it refers to an investment philosophy, we continue to have investment committee meetings and the agenda. We've got an agenda of we have third party support comes in and helps us and guides us through this. Agenda item number 1 on every investment committee meeting is: does this stuff still work? Is there any new evidence which has come to light, which makes us pause for reflection, makes us explore a bit more? Whatever your deeply held beliefs are, you should always be open to challenging them or looking for new evidence to come to light. In all the years we've been doing it, despite the fact that's on the agenda, every now and again something does come up. To be fair, there's a paper written by someone or others. Interesting. Let's explore further. And without exception so far, it's been, well, it's a 6-year data set. It's not long enough to, or whatever, or it's they've got confused by something. There's never been sufficient independent, research or data to make us change in any way our investment philosophy. But I think that's important to do. Don't just continually just say my way is the best way, all the rest of you are stupid. Be prepared to challenge your current thinking. The last question that I'm going to raise on this little excerpt, which I do think is not an unreasonable one, because someone just pushed back. So again, just to remind you, we've been talking about this for a while. I think there's merit in advisors encouraging their clients who are sitting in a broadly 60-40 or 50-50 type portfolio to just dial it up a bit, to move to an 80-20, which means the expectation is higher returns alongside some higher volatility across that portfolio. And one of the pushbacks was, yes, but what if the clients can't sleep at night? Nick.
But okay, thanks, Carl. Well, I think if they're already with you and they've been with you for a number of years, say they were with you in that crucible of 2007 to 9, the upside beforehand and then the calamitous roller coaster ride for the next 2 years, and they've been with you. If they weren't with you then, they've been through subsequent things: the Wuhan bedwetting, that 34% decline in 33 days, the Liz Truss attempt at reining in spending and doing something sensible with taxation that apparently spooked the markets, and bond, all that chaos, everything we've had. I think they're going to trust you when you say to them, listen, I as you just said, Alan, when the facts change, I change my mind. I don't think a 60-40 portfolio is really giving you the best opportunity. I think we go to 80-20, and they'll do it because it's you. If you do have clients who the extra 20% equity asset allocation would give them sleepless nights, then that's a reflection on your onboarding service as much as anything else, and you might want to disengage. At the end of the day, the clients might say, well, it's my money and I want it 60-40. So anyway, so I'm going to keep it where it is. I'd be very surprised if just ratcheting up from 60-40. I mean, God forbid, I've got so few clients in 60-40. I'm just trying to think, but I mean, I imagine 2 or 3 years ago, and then with that sudden rise in interest rates where we saw bond prices fall, I imagine there were some really difficult conversations with clients then who are maybe by nature more nervous, so they're in a 60-40, actually had a really bad ride because that 40% element of the portfolio that's supposed to be the bit that didn't give them the willies had a horrendous time, didn't it? So you were talking them off a ledge probably every day. I don't think it's a problem. We're here to help clients manage their behaviours through constant empathy and education, and just getting the clients to understand that we are on your side. We have no vested interest in this. We have no skin in the game. We don't represent a fund management group. We don't work for a fund management group. We don't work for a bank. I'm giving you my best advice because you will do well by it, and if you do well by it, I will do well by it. Now get out of my office.
If I just tell you to put your money into cryptocurrency or Japan, I'm getting paid the same. So I'm here to give you what I think is my best shot here. Couple of points on that, Nick. We do have a lot of 60-40 people, and I think we have them all appropriately invested in their medium-term portfolios. That the point you just raised is the reason for people not to be moving out of 60-40 portfolios right now. But yes, having the conversation about longer term stuff, certainly for new money. But you touched on exactly the point. Your onboarding process is really important, that you use that as your educational piece, and that you do talk about these maximum drawdowns, and that it's short-term volatility, but in the long term. And Andy describes this stuff really well, so it's a pity he's not here. But it's like, do you want not a low risk fund? Do you want a low return fund or a high return?
That's just reframing it. And a high return fund or low. I'd like the high return one, please. Absolutely. It does come with a little bit more volatility. You okay? Yeah, it's fine. How you frame it.
Yeah. And let me show you how this. So I do think that's the kind of communication, the education, the honesty at the outset, the honesty to have the courage of your conviction to say this has happened before, it will happen again, and here are the ballpark numbers. So you're talking to them about it, but this is appropriate for you because let's go back to our financial plan and let's see when you're going to need this money. This is long-term investing. So I think it's about how you're framing it at the outset, because if you don't do that, and it's easier not do that at the start, right? Because you do, inverted commas, risk losing a client, right? Because in case you might scare the shit out of them, right? So you have to have the courage of your conviction to actually be brave enough to have those discussions at the outset, so that they're not then surprised when things happen, because that's when really detrimental stuff can happen and people go jumping out of portfolios.
I've always said early client meetings, this is not an if, this is a when. It's just a matter of when your portfolio suffers a 20, 25, 30% short-term correction. There's never been a time in history where it hasn't recovered to greater highs, but it's a bit uncomfortable. So I'm just telling you, this is not, it might happen, it will happen, but this is, and then you go to explore and explain that. And this is the point about this. And this is the thing that kind of frustrates me. If you think across the board, and everyone gets wrapped up, and you used a good sort of explanation there, Carl, words and language are so important. This comes back to this perennial subject, humans, about risk versus volatility. And those risk. No one wants risk. No one wants volatility. But I want to have independence, financial independence. I want to help my children, my grandchildren. I want to do all these good things. Okay, well, fine. And the truth is somewhere between the two. Now, if your client literally says, I wouldn't sleep a wink at night if my portfolio fell by X, I don't even know what the data is. There can't be that much difference between the biggest drawdown on a 60-40 and biggest drawdown on an 80-20. It will be material, but it won't be like 3 times the amount. But that's where the magic lies. Now, at the end of the day, if the client says, no chance, I wouldn't sleep a wink all night, it'd be just dreadful for me, then fine. If that's the thing, we've failed in our duty to educate, inform, and coach. Fine, but we recognize that not everyone is rational. Some people are scared of snakes or spiders or whatever it might be, and there's not a lot you can do to deal with that in the short term. And what you were saying, Nick, a man persuaded against his will is of the same opinion. Still. So you don't want to browbeat somebody, but this is why I put that tweet out, because I said you'd earn your fee 10 times over. Because over the next 30 years, you're using 120 years of history as our guide. No guarantee the next 30 years will be exactly the same. Then no, they won't be. But they're likely to be broadly similar in that allocating some of your wealth to human ingenuity, creativity, and progress is likely to be rewarding. If it didn't, then the entire financial system would have broken down. That's a trade-off. That's a trade-off you get. Accepting short-term volatility gives you higher returns.
Yeah.
If you could get higher returns for lower volatility, everyone would do it and the market wouldn't exist. So this is...
And you wouldn't get the higher returns because you wouldn't need the compensation. You cannot get uncompensated returns.
This is the point.
And just to close, I think we should close because it's 90 minutes in. Carl used the word surprised. It's perfectly okay for your clients to be shocked when they see the valuation of their pensions or whatever ISAs, unit trusts go down in value during temporary decline. Because it is a shocking. They must never be surprised. That's the difference. They must never not know this couldn't happen. And that's why the education, cliche again, but you do the lifeboat exercise when the boat's in the still water in the dock. You don't do it when Colin Captain has just clipped a great big glacier and the thing's listing. It's too late. People won't listen.
Sorry, Nick. As we're wrapping up here, right? I'd love to get a debate going, a proper debate with people who believe the opposite of what we're saying, because I genuinely don't believe there are valid arguments or that there are things that we can't explain as to why this is the best way forward. Of course, people have different views, but I'm always minded.
Heads, Carl, wouldn't we? Just be butting heads.
But I'm always minded of asking these active fund managers: Would you invest in a capital asset management plan, i.e., long-term investment, or the one that you're peddling yourself?
I think we know the answer, don't we?
But we don't disclose it publicly.
Okay,
let's move on.
Okay, listen, we're 90 minutes in. I'm proposing that we skip the Trappist questions for this episode because we've still got to do Culture Corner. Jill, you'll be very patient. You're in the hopper. Jill Turner, we will do you in episode 51 in terms of answering your question. That was poorly phrased. Let's move on to the Culture Corner. Oh, God. It's a hot day. It's 29 internal temperature in my office. I'm just dissipating into a puddle.
No air conditioning in Watford.
Okay. Not in my office. No, we don't. Okay, I'm not going to read out any prompts.
Right. So straight on to me. First, there's a book. Now, this book has been out for, I think, the best part of 40 years. I've heard about it before, but just my friend of mine, when I was just up in Scotland last week, David McChrystal, shout out to David, Irish man, but he's a listener. He's a listener to the podcast, despite the fact he's not in our industry at all. He's a property man, as a lot of Irish people seem to be. But we
sorry about
were
that,
having
David.
a glass of wine, and David likes a glass of wine. He likes several. But we were chatting about stuff and little sort of tips and tricks and and he said, "Have you ever read Swim with the Sharks Without Being Eaten Alive?" Swim with the Sharks Without Being. I said, "No, I have not." So he gifted me his own copy, but it's by a guy called Harvey Mackay, American guy. And it is dated for sure. It's pre-internet, but it's brilliant. It's just full of loads and loads of little snippets and sound bites about selling, God forbid, about working with customers, about building rapport.
Yeah.
It's a kind of, it reminded me a bit, Nick, of one of our favorites, How to Win Friends and Influence People. And I looked him up. He's got his own website and so on. An interesting thing he does, you can just download a template. It's called the Mackay 66. And it's just a list of things that you should know about your customer. All the things that we've talked about in the past, like in your CRM system, but they're the kids, the children's names, his hobbies, his clubs he's a member of, all that sort of stuff. And Harvey Mackay owned, of all things, an envelope company selling envelopes, but at scale, mass stuff and stuff. And all his salespeople would look at their 66 thing and go in, old school, build rapport, position the thing, and sell their stuff. But anyway, it's a nice book, worth getting. Got it. It's available on Amazon. Swim with the Sharks Without Being Eaten Alive. Thank you.
Great stuff. I've actually just bought it on Kindle for £7.99, and the book came out in October 1989, which that was when the New World was coming in, when the Berlin Wall was just about to come down, and Eastern Europe was it's just a different world, completely different world. Amazing time. Okay, my culture corner. Does it have anything to do with people, with our thing of ours and finance? A little bit. It certainly has a lot to do with human beings and mistreatment of human beings around money. The post office or Mr. Bates versus the post office was the ITN 3-parter that came out a few months ago about the scandalous, and the word scandal is overused sometimes. This was an absolute scandal. The Horizons computer scandal, the Fujitsu Horizon computer scandal, and this is the story of it, and it is just heartbreaking, and it beggars belief. I think we all know what happened. These sub postmasters were given this very, very poor computer software to use in 1999-2000. They were given minimal training and told to use this. And the reason this is so sad is that sub postmasters, the kind of people who are the community for a lot of these little villages. I'm sure it's the same maybe in Ireland. I imagine it is the same. That the post office is where you have the board, the notice board, lost property, whatever. The sub postmaster knows everybody. These may not be high alpha people, okay? They may not be technically that great, but they're just good. They're good little people, okay? And they were absolutely screwed over a barrel by Fujitsu. When this system wasn't working and they couldn't reconcile it daily, they had to pick up the losses. And these losses got bigger and bigger and bigger. And every time one of these poor buggers phoned Fujitsu, the helpline, they were told, no other sub-postmaster has reported a fault. Yeah. It must be down to you. Scandalous. And people lost their lives. They lost their names. Loads of people lost money. And in the end, it came good. But the book is brilliant. It's 500 pages. And the last quarter is heavy on the legal stuff. But it's very well documented. But if you want to see how rotten our establishment is and how they went they all en masse came together to make sure these sub-postmasters never had a fair chance for years and years and years. Read The Great Post Office Scandal by Nick Wallace. It's just an eye-opener. It's just a real scandal. Right, there we go. Boys!
You shouldn't have called me out, right? Because I knew clearly it was me.
Sorry,
next.
I was in the
Anyway, do business, do life. Brad Johnson, I've mentioned him before. Try on my holidays to listen to stuff that's maybe a little bit different. So why were you listening to a financial planning podcast? I hear you say it's actually a little bit about his personal story and some of the struggles he had in terms of work-life balance, in terms of setting up a business, feeling the pressure of a business. And his message is kind of every entrepreneur or business owner or whatever you want to call it should be in some type of therapy. Now, he does qualify it by saying you should have a coach, you should have a mentor, you should have someone that you can talk to. I firmly believe he's correct. I have probably all of the above. And by God, I'm happy I do. And I'm in a much better place for it. And I think anybody who's struggling a little bit in business, have a listen to that and then take his advice. I think it's a really good episode and just worth hearing sometimes that if you're having a little bit of a struggle and it seems that everyone else around you has been, massively successful, that's just not the case. And go and talk to somebody and you'll be amazed how that will help you through the bad times to get to the good times, because good times are ahead, I promise you.
Interesting. I had one session with a therapist once, then she abruptly retired and wouldn't take my call, blocked my number.
I don't think she
Strange.
retired. I think she's in therapy herself now.
I agree. You should have a therapist.
Ultra's not here.
Nick is mine. Nick is mine.
Got-
Every time I've got something on my mind,
Yeah.
send him a little WhatsApp, and he tells me to sort myself out.
Pull yourself together. Hearts isn't here to give his one. Shall I put it? I mean, this is probably annoy Ultra, but Dirty Pop Netflix. I do know a bit about this. This is the boy pop impresario
Yeah,
Lou
Backstreet
Pearlman,
Boys.
who NSYNC and Backstreet Boys. It's a very good, apparently, Netflix documentary. This guy was it's a complete Ponzi scheme in terms of what he was doing with the money. But maybe we'll let Ultra give it justice. When he returns to it, what a tech snafu from the Tech Wonder
Yeah,
Boys. Well,
I know.
oh, blimey, wrong charger, flat battery, wrong microphones at the start.
Absolute
Anyway,
shambles.
it is what it is. Absolute shambles.
Absolute shambles. There we go. We're done.
we're
Absolute
done.
shambles.
Okay, I think we are done. Okay, so we are at Jesus,
One day
wet
we'll
shooting, 1 hour
get this
40.
done 100% perfectly. No tech balls ups. But
I think it's the overseas
don't
trips
help.
do tend to, for want of a better
just
word,
do what
bollock
Carl
us, don't
does. Just say,
Yeah.
talk to the
they?
hand.
Do what Carl does.
Yeah.
But have I not proven
Every
that I'm
bloody
right
time.
at this stage, for
I
Christ's
have yet
sake?
to goof up overseas,
yeah.
but it's coming. It is coming, without a doubt.
You did, you had the cleaning lady and everything coming into you in Sicily when you got stuck there. So you did.
I worked that into comedy gold. That's the skill, you see. Right.
Depends on
That's
your
it.
definition of
Okay,
comedy
all right,
gold.
All right, belt up. Come, we gotta do this,
Come on.
guys. Otherwise, we'll be all day. That is a wrap for the episode. Thank you, dear Trappists, for leaving. Please do leave a 6 out of 5 star review on iTunes. Like and subscribe to our YouTube channel. I think we're at 860 subscribers now, so we're getting very close to hitting the magic 1,000, and then still not earning any money because we get demonetized anyway. So until the next time from the Trap Pack, it's adios. Take care out there, and we'll see you on the other side. Goodbye.
Bye bye.
Yo, what happened to Heart?